Okay, let's jump right in. Have you ever found yourself just, staring at a tax form, feeling like it's written in some kind of secret code?
Oh, absolutely. Happens all the time.
Especially, right, when your business hits a rough patch, you've got losses, and figuring out the rules feels like, well, like navigating a maze blindfolded.
It really can feel that way.
Well, consider us your guides today, because we're taking a deep dive into a really crucial and, let's be honest, often misunderstood part of the tax code. It
Uh-huh.
directly impacts how non-corporate taxpayers, that's most small businesses and entrepreneurs, handle those exact losses. We're talking about Form 461, the limitation on business losses.
hmm
And this isn't just about, checking a box for compliance. It's really about understanding a critical piece of your financial puzzle, something that can truly reshape your long-term tax strategy.
That's a perfect way to frame it, actually. For anyone running a business, whether it's a buzzing startup or maybe a long-established company or even just a side hustle that's taken off, understanding how the IRS treats those business losses is just paramount. And it's not always intuitive, like you said. There are very specific rules that determine exactly how much of a loss you can claim in any given year. So, our mission today. Let's cut through the jargon. We'll walk you through the essential ideas behind Form 461. And maybe most importantly, highlight how knowing these rules can actually become a powerful form of strategic tax planning for you.
Turning a setback into an advantage later on.
Exactly. It's about turning what might feel like a current year problem into a future tax benefit.
Okay, let's uncomplicate the complicated then. Let's dive in. So let's start with the big picture. Why does Form 461 even exist? What's its main job, and why should you, our listener, really pay attention to it, especially if your business is showing a loss?
Well, it all really stems from a major piece of tax legislation, the Tax Cuts and Jobs Act, the PCJA.
Ah, yes, the TCJA. That changed a lot of things.
It really did. And one significant change was for non-corporate taxpayers how their business losses are handled. It fundamentally altered the landscape. You've really hit on the origin story of this limitation. Before the TCJA, business losses generally gave you more flexibility. You could often use them to offset other kinds of income without quite so many hurdles.
Simpler times, maybe.
Perhaps. But the TCJA, specifically for tax years starting after 2020 and running all the way through 2029, introduced this significant cap, a limit. This cap restricts how much loss non-corporate taxpayers, and again, that's mostly individuals, estates, and trusts, can actually claim from all their trades or businesses combined each year.
So it's an aggregate limit across everything.
That's right. And Form 461 is basically the IRS's official tool. It's how you calculate and enforce this specific limitation. Think of it like the gatekeeper for how much of your loss you get to use right away.
And here's where I think a lot of business owners have that aha moment, or maybe it's more like a sudden jolt, right?
hmm
The core truth is you cannot deduct an excess business loss in the current year. So imagine this scenario. You're, say, a talented graphic designer with your own studio. Last year was amazing, huge profits. But this year, maybe a big client pulled out, the market shifted, whatever the reason, you end up with a significant operating loss.
It happens.
Without knowing about Form 461, you might reasonably expect, okay, I'll use this loss to wipe out my personal income for the year, maybe even carry it back to get refunds from prior profitable years.
A logical assumption based on older rules, perhaps.
But then Form 461 steps in and basically says, hold on, not so fast. Your immediate deductions, they're capped.
Exactly.
And that can be a real shock if you haven't budgeted for it or planned for it.
It absolutely can be. And it's a common point of frustration, no doubt. But this is precisely where understanding Form 461 shifts. It stops being just a compliance burden and becomes a really vital long-term tax-saving strategy.
Ah, okay. So there's a silver lining here.
There absolutely is. While you can't deduct that excess business loss this year, it doesn't just vanish into thin air. That's the key. Instead, it's treated as a net operating loss, or an NOL carryover.
NOL carryover.
This means that disallowed loss gets deferred. It's held in reserve, you could say, for later tax years.
So it's kind of like a deferred tax asset. You don't get the benefit right away, but you can use it down the road when things are better.
That's a great way to think about it. You carry it forward to offset profits later.
That seems really significant for long-term financial planning, doesn't it? It means today's struggle, today's loss, could actually become tomorrow's tax relief.
Precisely. Think of it like you're building up a reserve of tax deductions. When your business gets back into the black in a future year, and most businesses aim to do that eventually, you can then pull out these carried over losses. Use them to significantly reduce your taxable income in those profitable years,
Or lowering your tax bill later on.
potentially significantly lowering your overall tax liability. So it's not just about surviving a tough year, it's about strategically leveraging today's setbacks for tomorrow's financial gain.
That's a powerful perspective shift.
It is, and for anyone wanting to dig even deeper into the mechanics of actually managing these NOL carryovers, how you track them, how you report them, Form 172 is your friend. That's the form for net operating losses for individuals, estates, and trusts. It gives you the specifics for those future tax years.
Good to know. Form 172, we'll keep that in mind.
Yep.
Okay, so that brings us to a really practical question, one that's probably on every listener's mind right now. Who actually has to file this Form 461? You mentioned non-corporate taxpayers. Can you break down the specific triggers? When does this form become unavoidable?
Sure, so as we said, non-corporate taxpayers is generally individuals, estates, and trusts. More technically, it includes those whose income might fall under IRS Section 511, which deals with unrelated business income for exempt organizations, but that's a bit niche. For most listeners, the key is this. You are required to file Form 461 if your net losses from all your combined trades or businesses exceed a certain dollar amount, a threshold.
Okay, what's the magic number?
For the 2024 tax year, that threshold is $305,000 if you're filing single.
$305,000.
And it doubles to $610,000 if you're married filing a joint return.
$610,000 for joint filers.
Got it. And importantly, you should know these amounts are indexed for inflation each year, so they'll likely nudge up a bit in future tax years. Always check the current year's threshold.
Right, so okay, quick example. If I'm a single entrepreneur, maybe running a consulting business, and my net loss for 2024 ends up being, say, $400,000.
Then you absolutely must file Form 461.
Because 409K is way over the 305K single limit.
Exactly, that's a textbook case. But there's another trigger too, and this one sometimes catches people a bit off guard.
Oh, that's that?
You also have to file if you would report a loss of more than $152,500 on any single line in Part 1 of Form 461, specifically lines 1 through 8.
Ah, so even if my total losses across all businesses don't hit the big $305K or $610K threshold, if one particular business activity has a really substantial loss, over $152,500, that alone triggers the need to file Form 461.
Correct. It ensures that even significant losses from individual ventures get captured and subjected to this limitation rule. It's designed to look at both the overall picture and major individual losses.
Okay, let's try another scenario then. Say we have a married couple filing jointly. They own a little bakery, lovely place, but had a tough year, lost $100,000.
Yeah.
But they also have a booming online retail business, maybe selling handmade crafts, that unfortunately had a $550,000 loss this year due to, I don't know, supply chain issues.
Right.
Their combined loss is $100,000 plus $550,000, which is $650,000.
Yeah.
That $650,000 is clearly higher than the $610,000 joint threshold. So they must file Form 461, right?
Absolutely. They must file.
What's interesting there is that neither the bakery, $100K, nor the online store, $550K, individually trigger that $152,500 single-line loss threshold you mentioned.
Good point.
But their combined losses push them over the main $610,000 limit. It really shows you need to look at your total business picture.
It absolutely does. And knowing these thresholds before you even start preparing your taxes is, well, it's a critical piece of proactive tax planning. It helps you anticipate needing the form, understand what it means for your current tax bill, and start thinking about that NOL carryover.
Makes sense. And practically speaking, where does this form go? Do you mail it separately?
No, it generally gets attached right to your main tax return. For most individuals, that means attaching it to your Form 1040 or Form 1040 SR if you're a senior, or maybe Form 1040 NR for non-resident aliens.
Okay, part of the main package.
Exactly. For estates and trusts, it would usually go with Form 1041. There are a few other niche forms too, like 1041 QFT or 1041N, and maybe even Form 990T for some exempt orgs with trust income. But the key takeaway, it's part of your primary annual tax filing.
All right, so we know why Form 461 exists and who needs to file it. But now, to actually navigate this thing, and more importantly, to make sure you're leveraging every possible tax-saving strategy, you really need to understand its specific language.
Yeah.
There are some definitions here that are just critical. Let's start with the absolute core concept, excess business loss itself. What exactly does the IRS mean by that phrase?
Right. The excess business loss is, by definition, the amount by which your total deductions from all your trades or businesses are more than your total gross income or gains from those same businesses. Plus, that threshold amount we just talked about, $305K single, $610K joint for 2024.
Okay, so it's deductions minus income compared to the threshold.
Essentially, yes, but it's a very precise calculation. You sum up all your relevant business deductions, compare that total to all your relevant business income and gains, and then factor in that threshold cap. And importantly, this specific calculation excludes a couple of key deduction types, namely deductions under Section 172, that's for NOLs themselves, and Section 199A, which relates to the qualified business income deduction. Those are kept separate.
Okay, good clarification. And there's another really crucial exclusion too, isn't there? Something about wages.
Yes, absolutely critical. This calculation specifically does not consider deductions, gross income, or gains that come from performing services as an employee.
So your regular W-2 job salary or any deductions tied directly to that employment, like maybe unreimbursed employee expenses if those were still broadly deductible, are completely separate from this Form 461 business loss calculation.
Exactly. It keeps the focus squarely on your entrepreneurial activities, your actual trades or businesses.
That distinction seems fundamental.
It is. This definition forces you, really, to rigorously categorize your income and deductions. Is it from a trade or business, or is it something else? Employment, personal investment, etc. You can't just lump everything together. You can't use your personal investment income, for example, to artificially inflate your business income side of the equation unless that investment income is directly generated from an active trade or business activity itself.
Rigorous categorization, got it.
Getting this categorization right is the absolute first, most critical step for accurate reporting. And therefore, it's the foundation for any effective tax strategy around these losses. Missteps here can just ripple through your whole return.
So speaking of that threshold amount, again, just to lock it in for everyone listening, let's quickly repeat those 2024 numbers. They're kind of the key benchmark here.
Happy to. For 2024, the threshold amount, your annual cap, is $305,000 if you're a single filer.
$305,000 single.
And $610,000 if you're married filing a joint return.
$610,000 joint.
And always remember, these are indexed for inflation, so they will change year to year. This is the number you compare your calculated aggregate business loss against to see if you actually have an excess business loss. It's the ceiling for immediate deductibility.
Okay. Now, you keep using that phrase trade or business. In everyday chat, it seems simple, but I know in tax law, definitions matter a lot. How does the IRS precisely define what counts as a trade or business for this purpose? What separates it from, say, just a hobby I have or a passive investment?
Yeah, that's a foundational definition because it determines which activities even fall under these rules, which losses might be limited, and which might generate those valuable NOL carryovers. An activity qualifies as a trade or business if your primary purpose for doing it is to make income or profit.
Primary purpose.
And crucially, you have to be involved in it with continuity and regularity. It can't just be a one-off thing or something sporadic. The IRS looks at all the facts and circumstances. Things like, how often are you actually doing things for this activity? Are you actively trying to generate income? What's the overall scope of your efforts? These are all important factors.
So it's not enough to just hope I make money from my, pottery making on weekends. I have to be actively, consistently trying to run it like a business.
That's a great way to put it. You don't necessarily have to actually turn a profit in any given year to be a trade or business. Many new businesses operate at a loss initially.
Right.
But you do need that genuine profit motive, and you need to be making ongoing efforts to further the business's interests. That's what separates a real business from a personal hobby where profit might be secondary or incidental, or from a purely passive investment where you just put money in but aren't actively involved.
Okay. And what about things like partnerships or S-Corp? If I'm just a silent partner, does my involvement matter, or is it the entity itself?
That's a really important detail, especially for people involved in pass-through entities. If you own an interest in a partnership or an S corporation, the trade or business determination deciding if the activity qualifies is made at that entity's level.
So it's based on what the partnership or S-Corp does, not necessarily my personal day-to-day involvement.
Exactly. The entity's activities dictate whether its income or loss is considered trade or business income or loss that flows through to you. Getting this definition right correctly, classifying your activities is absolutely key. Misclassifying something could lead to wrong loss calculations, potential IRS issues down the line. It really impacts your whole tax picture and any tax-saving plans.
Foundational indeed. Okay, now let's tackle something that often trips people up. It seems simple, but the rules here are quite specific. Capital gains and losses. How do they fit into this Form 461 calculation? Because it's not just a matter of adding them to the pile, is it?
You've hit on a really significant area of complexity, and it directly impacts your Form 461 result and, by extension, your tax strategy. It's a point of frequent confusion. First, and this is crucial for planning, losses from sales or exchanges of capital assets, think selling stock from your personal brokerage account, or maybe selling a piece of land you held for investment, not business use, makes the call. Those capital losses are not included when you calculate your total deductions from your trades or businesses for Form 461.
Wait, really? So if I had a bad year in the stock market, personally, lost $50,000 selling some shares, that $50 K loss cannot be used to increase my business loss figure on Form 461.
That's exactly right. Your general investment capital losses are kept separate. They cannot be used to inflate your business loss for the purpose of this calculation or to potentially create or increase an excess business loss.
Okay, that's a huge distinction. What about capital gains then? If I sell, say, some business equipment at a gain, does that count as business income?
It can, but with limitations. Gains from capital asset sales or exchanges that are related to your trade or business. Well, the amount you can include as business income on Form 461 is limited. It should not exceed the lesser of two amounts, either your capital gain net income that's attributable only to a trade or business, or your overall capital gain net income from all sources.
Whoa, okay. Lesser of business capital gain or total capital gain. That's specific. Why the complexity there?
It's essentially an anti-abuse rule. It prevents you from artificially inflating your business income side of the Form 461 calculation by including non-business capital gains, just to try and avoid hitting the excess business loss threshold.
Ah, I see. They want to keep the calculation focused purely on the operating results of the business, including gains specifically tied to business assets, but not general investment gains.
Precisely. It keeps the limitation focused squarely on active trade or business operating losses and truly related business capital gains within those specific bounds. Understanding this nuance with capital gains and losses is absolutely critical for filling out the form accurately and making sure your tax planning, your tax saving strategy is based on the correct figures.
Okay, so we've defined the key terms, explored some tricky areas like capital gains. Now, before we even think about filling in the boxes on Form 461, you mentioned there's an important sequence, an order we need to follow, like a tax checklist almost. What comes before Form 461?
Yes, that's a critical point. Just jumping straight to Form 461 without dealing with prior rules is a really common mistake, and it can lead to totally incorrect filings. The IRS has a very specific hierarchy, a pecking order, for how different types of loss limitations are applied.
Okay, what's the order?
First, and this is foundational, you must apply the at-risk rules. These basically limit your deductible losses to the amount you personally have at risk in the activity, like cash invested or loans you're personally liable for.
At-risk rules first.
Got it. If your loss clears that hurdle, next you apply the passive activity loss rules. These rules generally prevent you from deducting losses from passive activities where you don't materially participate against your non-passive income, like wages or portfolio income.
Okay, so at-risk, then passive activity.
Correct. And only after your loss has made it through both of those filters, then you apply the excess business loss rules using Form 461. It's a cascade.
Why does this order matter so much? What's the thinking behind these layers?
The logic is about validating the nature of the loss before limiting its immediate use based on sheer size. The IRS wants to first ensure you've actually got skin in the game, that you've truly put your own capital at risk. That's the at-risk rules.
Makes sense.
Then they want to confirm it's not just a loss from some passive investment where you weren't actively involved. That's the passive activity loss rules. Only once those hurdles confirm it's a genuine loss from an activity you're at risk for and potentially actively involved in, then the IRS looks at whether that active business loss is excessive under the TCJ's specific dollar limitation. It's a layered approach to ensure only legitimate active business losses even get considered by Form 461.
It's like a filtering system. Only certain losses even make it to the Form 461 stage.
Exactly. And for listeners who need a deeper dive into those first two layers, the at-risk and passive activity rules, IRS Publication 925 is the main resource, along with Form 6198 for at-risk limitations. Our focus today is on what happens after those rules have done their job.
Got it. Pub 925 and Form 6198 for the pre-filters. Now, are there any unique twists for specific types of businesses? You hear about farming having its own set of tax rules sometimes. Does that apply here?
You're right, farming does get some special attention here. If you have losses from a farming business, the excess business loss limitation calculated on Form 461 is applied before you consider carrying any resulting net operating losses, or NOLs, back 2 years. That's a specific procedural point for farmers.
All right, timing difference.
And there's more. If you happen to have both farming losses and non-farming business losses, and your total losses exceed the threshold amount, $305K, $610, there's a special allocation rule. You have to allocate that threshold amount first to the farming losses, but only up to the extent you actually have an NOL. It essentially prioritizes applying the limit against farming losses in that specific scenario.
Wow, that sounds complex. So farmers, or people with both farm and non-farm businesses, really need to pay attention to that ordering.
Absolutely. It can definitely impact the timing and utilization of their NOLs. For anyone in that situation, Publication 225, the Farmer's Tax Guide, is the essential resource for the full details.
Pub 225 for farmers. Good tip. Okay, what about losses from prior years? Do they just disappear? Or do old limitations somehow affect this year's Form 461 calculation? This touches on how tax years connect.
They absolutely connect. They don't just vanish. This reinforces why keeping good records year after year is so crucial. The IRS calls this concept transition rules. If you had losses or deductions that were limited in prior tax years because of other tax code rules, maybe they were suspended by the at-risk rules or the passive activity rules back then, those previously limited amounts, when they become deductible in the current year, are included when you figure out your current year's excess business loss calculation on Form 461.
So a loss that was stuck in limbo because of, say, passive activity rules in a prior year finally gets released this year, but it still gets tested against the Form 461 limit now.
Exactly. Limitations from previous years don't just evaporate. They can still impact your current Form 461 calculation when they eventually become deductible. It really underscores the cumulative nature of tax planning. You need good historical data. Without it, you might miscalculate your current year's limitation or miss out on properly utilizing those carried over amounts. It definitely impacts your tax saving potential.
Okay, we've laid some serious groundwork here. We get the why, the who, the key terms, the crucial order of operations. Now let's get practical. Let's actually navigate Form 461 itself. We won't read every single line instruction like a textbook. That would put everyone to sleep. But let's focus on the purpose of each main section and maybe highlight those key spots where taxpayers often get tripped up. We want you, the listener, to understand the why behind each step for better planning.
That's the perfect approach. Focus on the concepts, not just the line numbers. A few quick general pointers first, though. If you're married filing jointly, remember you fill out just one Form 461, combining everything for both spouses.
One form per joint return. Got it.
If you ever need to file an amended return for a year where Form 461 applied, make sure you attach it to that amended return too.
Okay.
And while many line instructions point to Form 1040 or 1040 SR, just remember that equivalent lines and instructions exist for other returns, like the 1040 NR for non-residents or Form 1041 for estates and trusts. Always check the instructions for your specific main tax form.
Good practical tips. Okay, let's start with Part I, titled Total Income Loss Items. What's the goal here? What are we trying to scoop up in this first section?
The main objective of Part I is basically to gather all the income and loss figures reported elsewhere on your tax return that might be related to a trade or business. Think of it as the initial data dump. You're pulling numbers from various schedules and lines of your main return, Schedule C for sole props, Schedule E for rentals and pass-throughs, Schedule F for farms, capital gains from Schedule D, etc., before any specific Form 461 adjustments are made.
So it's casting a wide net initially, bringing everything potentially relevant onto this form first.
Exactly. It's the raw input stage.
So without getting lost in every single line number again, what are the types of things that end up here in Part 1?
Well, you'll see lines pulling in figures like business income or loss, often from Schedule C, or maybe partnership K1s reported on Schedule E, that flow through Schedule 1 of the 1040. That's on line 2. Capital gains or losses, typically from Schedule D, reported on the main form 1040-1040-SR, line 7. That goes on line 3. Other gains or losses, maybe from Form 4797, sales of business property, flowing through Schedule 1. That's line 4. Supplemental income or loss from Schedule E is huge here on line 5. This captures things like rental real estate income loss, royalties, and importantly, income or loss from partnerships, S corporations, estates, and trusts, a very common source for business owners.
Okay, Schedule E is key for pass-throughs.
Absolutely. Then there's farm income or loss from Schedule F on line 6. And finally, a catch-all line, line 8, for any other trade or business income, gain, or loss that wasn't captured on the earlier lines.
Okay, so it tries to cover all the bases where business activity might show up on a return.
It does. And after you've entered all those relevant figures, line 9 simply combines them all. It adds up lines 1 through 8 to give you an initial aggregated total income or loss figure. This number on line 9 could be positive or negative.
Now, hold on. Line 3, capital gains and losses. You mentioned earlier how tricky these are. How does Part I handle that? Does it just pull the number straight from Schedule D?
It generally starts by pulling the overall capital gain or loss figure from your return. But this is precisely where you need to be super careful and remember our earlier discussion. This is a major tripwire. Because, remember, losses from sales of capital assets are not included in the final business deduction calculation for Form 461. So even if you enter a net capital loss on line 3 initially, because that's what your Schedule D shows, you're going to have to specifically remove that loss later in Part 2.
Okay, so Part I might include it, but Part 2 fixes it.
Exactly. And similarly, any capital gains included on line 3 that are not attributable to your actual trade or business, like selling personal stocks, those also need to be removed later in Part 2.
So Part 1 is just the starting point, the raw data. It's not the final business income loss figure for the limitation calculation yet.
Precisely. Part 1 gathers the potentials. Part 2 does the refining. This distinction is vital for accuracy and effective tax-saving strategies.
Okay, this is where it gets really interesting then. Like you said, we've basically thrown all these numbers from our tax return into the Part I pot, but we know some of them don't truly belong, the non-business stuff, those excluded capital losses. So Part 2, titled Adjustment for Amounts Not Attributable to Trade or Business. This is where we do the cleanup, the surgical removal.
That's the perfect analogy. Part 2 is absolutely critical. Its entire purpose is to meticulously remove any income, gains, losses, or deductions that you reported back in Part 1, but that are not actually from a bona fide trade or business, as the IRS defines it. This is how we ensure that the final calculation in Part 3 is based strictly on your qualifying business activities. It's separating the business wheat from the non-business chaff, you could say.
Makes sense. So how do we perform this separation? What are the key lines in Part 2 doing?
Okay, there are really two main adjustment lines here. Line 10. This is where you enter the total amount of income or gain that you included back in Part I, on lines 1 through 8, that was not from a trade or business.
So like if I had interest income from a personal savings account that somehow got swept into Part I, I'd put that amount here on line 10 to subtract it out, or those non-business capital gains we talked about.
Exactly. You're removing non-business income here so it doesn't incorrectly reduce your potential excess business loss. Then there's line 11. This is where you entered the total amount of losses or deductions that you included back in Part I, loans 1 through 8, that were not from a trade or business.
Okay, removing non-business losses and deductions. But wait, here's that caution sign I remember you mentioning earlier, something about positive numbers.
Yes, absolutely crucial point, and honestly probably the single most common place people make a mechanical error on this form. Even though you are entering losses or deductions on line 11 amounts that are typically negative numbers on other parts of your tax return, you must enter them as a positive figure on this specific line.
Enter losses as a positive number. That feels totally wrong. Why?
It does feel counterintuitive, but it's how the form mechanics work. Entering the non-business loss or deduction as a positive number on line 11 effectively adds it back to your income for the purpose of this specific calculation. It cancels out the negative impact it had in Part 1.
Ah, okay. So putting a positive $10,000 non-business loss here cancels out the negative $10,000 it contributed in Part 1.
Precisely. It neutralizes those non-business items. And critically, this line 11 is also where you formally add back, again, by entering them as a positive number, those losses from sales or exchanges of capital assets that you might have included on line 3 in Part 1. Because remember, those capital losses are specifically excluded from the business loss calculation.
Wow, okay. Getting that positive entry correct on line 11 is absolutely fundamental then. Mess that up, and your whole calculation is thrown off. Could cost you real money in missed tax savings or cause errors.
Huge potential impact. It's a detail you absolutely have to get right.
That's a massive aha moment, I bet, for many listeners. That positive number convention is key.
Definitely a key takeaway. After you've made those crucial adjustments on line 10 and line 11, then line 12 is straightforward subtraction. You subtract line 11, the positive value of non-business loss deductions, from line 10, non-business income gains. The result on line 12 tells you your net gain or loss that was not from a trade or business, and this figure then feeds into the final calculations in Part 3.
Okay, deep breaths. We've gathered the raw data in Part 1. We've meticulously filtered out the non-business stuff in Part 2, remembering that positive number trick on line 11. Now, finally, we arrive at Part 3, limitation on losses. This is it, right? This is where we apply that threshold amount, 305 keys, 610 KL, and figure out the grand total, the actual excess business loss, the moment of truth.
This is indeed the culmination. Part 3 is where the final math happens. First, on line 14, you essentially combine the result from Part 1, your raw total on line 9, with the net adjustment from Part 2, which comes from line 13, incorporating that line 12 calculation. This line 14 figure represents your net income, or, more likely in this context, net loss strictly from your trades or businesses after all the filtering. It could be positive or negative. And then we get to the line everyone using this form is waiting for, line 16. This line reveals the final answer. Is there an excess business loss, and if so, how much?
Okay, so what does the number on line 16 tell us? If it's, say, a negative number, what does that signify? And more importantly, what do we do with that information? This feels like where the rubber meets the road for tax planning and saving.
You got it. If the final calculated figure on line 16 is a negative amount, then that negative amount is your excess business loss for the year.
So if line 16 shows, let's say, megach $100,000.
Then your excess business loss for the year is $100,000. That's the amount of your business loss that exceeds the allowable limit for the current year.
Okay, I have a $100,000 excess business loss. Now what? Here comes another twist, right? How do I report this on my actual tax return, like my Form 1040?
Yes, another crucial reporting instruction here. And again, one that seems counterintuitive but is absolutely vital for your tax strategy and accurate filing. Even though line 16 shows a negative number representing the disallowed loss, you must report this excess business loss adjustment as a positive number on the other income line of your main tax return.
Report a loss as income. Okay, explain that.
Think of it this way. The positive entry on your main return effectively cancels out the disallowed portion of the loss you claimed elsewhere. For most individual filers using Form 1040, this positive adjustment goes on Schedule 1, Line 8P, labeled Other Income. And you also need to write ELA, which stands for Excess Loss Adjustment, on the dotted line next to that positive number.
So my example, line 16 on Form 461 is negative $100,000. I then go to Schedule 1, line 8P, and write in plus $100,000 and put ELA next to it.
That is exactly correct.
And the effect of adding $100,000 back to my income is it basically neutralizes that portion of the business loss for calculating my current year's taxable income. It stops me from using that excess $100,000 loss to reduce my other income, like wages or investments, this year.
Precisely. It enforces the limitation. The IRS is effectively saying, yes, you had this $100,000 loss beyond the threshold, but you can't use it to lower your taxes now. We're adding it back to your income calculation for this year.
Wow. Okay. That really drives home the limitation part of Form 461's name.
Yep.
It directly stops that excess loss from reducing your current tax bill.
It's a direct illustration of the limitation in action. Understanding this final reporting step, reporting the negative loss as a positive income adjustment, is absolutely key to avoiding underpayments, miscalculations, and ensuring your return is correct.
Phew. Okay, we made it through the form. We navigated the parts, decoded the lines, dodged the tripwires like positive numbers for losses. So now, the big so what? What does this all mean for you, the listener, beyond just the mechanics of filling out another form? What's the real-world, practical, strategic implication here? How can understanding this limitation actually become a powerful tax-saving method for your future? This is where that NOL carryover concept comes back, right?
This is absolutely where the true strategic value lies. The most important implication, the thing that shifts this from just a compliance headache to a genuine tax advantage, is exactly that. The excess business loss you calculate on Form 461, the amount you had to add back as income this year, it is not simply disallowed and gone forever. That is crucial. It is treated as a net operating loss, or NOL carryover. It gets carried forward to subsequent taxable years.
So it's not a permanent loss of the tax benefit, it's a deferral, a delay. You just can't use it yet. That's a massive distinction for strategy.
Huge distinction. It's like putting those disallowed losses into a tax advantage savings account, just waiting for the right year to withdraw them and use them.
That's a great analogy. A tax savings account for losses.
And this NOL carryover mechanism is an incredibly powerful tax-saving tool. It means that when your business, hopefully returns to profitability in future years, you can then use these carried over NOLs from prior years generated by Form 461 to offset that future business income.
Reducing your taxable income in those good years.
Exactly. Potentially significantly reducing your taxable income and therefore your tax liability in those profitable periods. This transforms what feels like a painful current year limitation into a valuable deferred asset. You can strategically deploy it to minimize your future tax burdens. So understanding Form 461 isn't just about getting this year's return right. It's about setting up a long-term tax reduction strategy that could benefit you for years to come.
Let's try to make this really concrete with an example. Let's go back to Sarah, our single entrepreneur. In 2024, she had that $500,000 business loss. The single filer threshold was $305,000.
Right.
So doing the math, $500,000 loss minus $305,000 threshold means she had an excess business loss of $195,000.
Correct. $195,000 disallowed in 2024.
So she adds $195,000 back as income on her 2024 return. Painful. But now, fast forward to 2025, her business bounces back. She has $250,000 in taxable business income. What happens now with that $195K from last year?
Okay, great scenario. That $195,000 excess business loss from 2024 automatically becomes an NOL carryover to 2025. So when Sarah prepares her 2025 tax return, she looks at her $250,000 of business income. Then she gets to use that $195,000 NOL carryover from 2024 to offset it.
So $285,000 in NOL carryover.
Means for taxable income from the business for 2025 is reduced all the way down to just $55,000. $250K, $195K, $55K.
Wow. That dramatically cuts her tax bill for 2025, doesn't it?
Absolutely. It's a huge benefit. That painful loss limitation in 2024 directly leads to significant tax savings in 2025. And if, hypothetically, her NOL carryover had been larger than her 2025 income, say the NOL was $300,000, she'd use $250,000 to wipe out her 2025 income entirely, and the remaining $50,000 of NOL would carry forward again to 2026.
So it keeps rolling forward until it's fully used up.
Generally, yes. Under current rules, NOLs generated in recent years can be carried forward indefinitely until used, though there can be limitations on how much NOL you can use in any single future year, often limited to 80% of taxable income. But the core principle is you carry it forward. This proactive management, understanding the limitation, tracking the carryover, turns that initial loss into a really valuable future tax offset. And again, for the nitty-gritty on tracking and reporting these NOLs in future years, Form 172 is your guide.
That sounds fantastic. A real potential game changer for businesses that face volatile income streams.
Yeah.
But actually get that benefit years down the line, I'm imagining that keeping meticulous records is absolutely non-negotiable.
Right. You have hit on arguably the most critical, practical aspect of this entire strategy.
Yes.
You absolutely must keep detailed, organized records of your excess business loss calculation from each tax year it occurs.
Not just remembering the final number, but how you got there.
Ideally, yes. You need documentation showing the initial loss, the calculation on Form 461 leading to the excess amount, and then tracking exactly how much of that resulting NOL carryover gets utilized in each subsequent year. Without accurate, well-organized records, you simply won't be able to properly track and substantiate your NOL carryovers when you need them years later.
Meaning you could effectively forfeit those tax benefits.
You could. You might underutilize them, or worse, not be able to defend the deduction if the IRS asks questions years down the road. Lack of documentation is a killer for NOL carryovers. And this really raises an important practical question for everyone listening. In today's world, with information everywhere, how are you ensuring you're keeping the kind of meticulous records that will actually benefit you maybe 5-10 years from now when you need to activate these NOLs?
Good question. What are the options?
It requires a proactive system. Maybe it's dedicated accounting software that tracks this. Maybe it's working closely with a tax professional who maintains these records for you. Or, if you're doing it yourself, it means rigorous personal organization. Maybe a detailed spreadsheet, securely stored digital copies of returns and worksheets, or even a well-organized physical file system. Whatever works for you, but don't underestimate the power and necessity of a well-maintained ledger for NOLs.
Crucial point. It's not enough to know the rule. You have to manage the implications actively. Now, thinking about managing this, are there other common mistakes you see people make when trying to use these NOL carryovers? Besides just poor record keeping, what are the pitfalls to avoid?
Yeah, a few things come to mind. Beyond the records, a big one is failing to consistently distinguish between business and non-business income and deductions over time. If your categorization drifts year to year, it can mess up both the initial EBL calculation and the NOL tracking.
Consistency is key.
Another common error is forgetting those ordering rules we discussed earlier. Trying to apply the excess business loss limitation before fully applying the at-risk rules or the passive activity rules if they apply. The order matters.
Right. Got to follow the sequence.
I've also seen taxpayers forget to account for those transition rules. They don't factor in prior year suspended losses when calculating the current year's Form 461. They treat each year as a totally clean slate, which isn't always correct.
The cumulative effect.
Exactly, and maybe the simplest mistake. After a few profitable years, some taxpayers just forget they even have NOL carryovers available from tougher times in the past. They just file their return without claiming the NOL deduction they're entitled to.
Ouch. Leaving money on the table.
Big time. It really underscores the need for a comprehensive, multi-year tax strategy, not just focusing on 1 year at a time in isolation.
That brings us right back to the core message, doesn't it? What does all this detail mean for you, the listener, in terms of empowering your own tax strategy? It really sounds like it transforms what seems like a harsh limitation into a really powerful tool for financial foresight.
That is precisely it. Understanding Form 461, warts and all, isn't just about filling out another government form correctly. It's about gaining crystal clarity. Clarity on how your business losses are treated now under the current tax code. And even more importantly, clarity on how you can strategically leverage those losses in the future. It's about shifting from being a reactive filer to being an informed taxpayer.
Someone who can turn that limitation into a proactive financial advantage.
Exactly. Knowledge in this specific tax context truly is a tax-saving asset. When you understand and apply these rules, you're not just reporting a loss anymore. You are actively, strategically managing that loss for future financial benefit.
It encourages a different level of thinking, doesn't it? About your business's financial path, about long-term tax planning.
It really does. It prompts you to consider the full life cycle of your business's financial health, not just this year's snapshot. It helps you see how today's challenges can be managed to create tomorrow's opportunities.
It really transforms what seems like just another annoying tax limitation into a potentially powerful tool for foresight in your financial planning. It's about being proactive, not just reactive, with your taxes. And there you have it. Our deep dive into the complexities and the opportunities hidden within Form 461, the limitation on business losses. We really hope this hasn't just given you the facts and figures, but maybe a whole new perspective, a perspective on how even complicated-looking tax forms can hold crucial insights for your financial well-being and definitely your long-term tax planning.
Understanding these intricacies, these rules, really does empower you. It empowers you to better manage your financial future. It's all about seeing how to turn what might feel like a current setback, that excess loss, into a valuable deferred asset you can use in future tax years. It optimizes your business's financial health across its entire life cycle.
Precisely. So as you look at your own business endeavors, maybe your side hustle, maybe your main gig, consider this question. How might really proactive record keeping, combined with a deep understanding of these loss limitation and carryover rules, how might that not just save you money on taxes down the road, but maybe fundamentally change how you approach your long-term business strategy? Something to think about, isn't it? Food for thought. That's all for this deep dive. Until next time, keep learning, keep questioning, and always keep digging deeper.